If you don't understand how to do top-down analysis correctly, you're basically giving money away to the market. Today, I'm walking you through one of my biggest trades of the year, step by step, so you can just copy the process. Not only that, this video is absolutely stacked with gems. Today, we're going to cover how to do a correct top-down analysis from the higher time frame down to the lower time frame. We're going to understand how we can interpret a high probability draw on liquidity. We're going to touch on dealing range theory, what high probability fair value gaps are, how they form and what they look like. We're going to talk about high probability break-in structure, how we can incorporate the power of 3 model inside our top-down analysis, and I'm actually going to walk you through a real trade breakdown that I took using the exact systematic approach I take to top-down analysis. So you're going to see it from a weekly time frame all the way down to a 5-minute entry. So grab a notepad for this one because there's going to be a whole lot of information coming at you. Now, if you're fairly new to algorithmic price action concepts, then I've made a fantastic little resource called the ICT Bible. You can find that in the description below, and that will really help you when going through this video. Okay, so let's jump into a chart. Here we are on the weekly time frame for the British pound. Now, the first thing that I want to do when I'm on the higher time frames is I want to bracket out the highest high and the lowest low in order to determine where we have the major buy side liquidity pool and the major sell side liquidity pool. Right now, clearly here we have major buy side above this high. This is the highest high inside of all of this piece of price action. And down here we have major sell side liquidity. Now, this is also equal lows here. So there's going to be a very large pool of sell side liquidity below these lows. So already my eyes are going down here before I've even dropped down onto the lower time frames. See, you want to pay more attention to the higher time frames because that's going to be your longer term draw on liquidity, and this is where the big boys and the banks and the institutions are looking at. They're not down on your lower time frames. Now, the algorithm is only going to be drawn to one of two things: liquidity and inefficiencies. To make things very, very easy, what we want to do is anywhere on any time frame that we see equal highs or equal lows, that is going to be your strongest draw on liquidity, and you trade in that direction unless proven otherwise. In order to determine what the market is likely to do next, we need to look at what the market has already done. Now, if I anticipate the market is likely to draw down to these equal lows, I want to assess algorithmic order flow and that price delivery continuum from the higher time frame down to the lower time frame. Now, let's take this as a step-by-step approach. Based on this time frame alone first, what I can clearly see here is this premium wick. We can grade this wick with our DRT levels, and straight away I notice the reaction from that 25 DRT wick over here. After reacting from there, price really drops lower with a close down here. That's the first thing here that indicates that there is potential weakness behind this market. Also, note this fair value gap. From this candle's low to this candle's high, we have all sell side delivery. So this is an inefficient area of price, and we deem this as a fair value gap. Again, look at the clues here. None of the bodies here are managing to close above this weekly fair value gap. Again, this indicates a sign of weakness. So now I can see that based on algorithmic order flow, there are a few things here that is indicating lower prices. Now let's look at market structure. This swing low down here was that last swing low inside of this leg of price action that raided the last swing high. So all of the liquidity above these highs up here was purged over here. And then price drops back down again and closes right through this swing low. This is a high probability break of structure. Not only that, this break of structure is qualified with the presence of this fair value gap that is inside of the leg that breaks structure after a raid on liquidity. Is very, very important. Taking this information, we can drop down to a lower time frame, and we're going to use the daily time frame over here. Now, this time frame allows us to flesh out a little bit more detail. And again, what we're going to do with this time frame is look for clues that will indicate price does in fact want to travel lower for these equal lows down here. Now, what I want to do here is I want to see where price currently is relative to the current dealing range. Now, the dealing range is going to be from the swing high down to the equal lows down here. Once we have established this, we can grade this entire range using DRT, where we have the dealing range high. This is the highest price inside of all of this price action. The dealing range low, which is the lowest price inside of all of this price action. The 50 DRT level, which is the fair price or the mid price between the highest price and the lowest price. And then in between that, we can have the 25 DRT level, which is the mid price between the 50 DRT and the dealing range high. And the 75, which is the mid price between the 50 level and the dealing range low. Between the fair price at 50 DRT and the highest price at the dealing range high, this is all going to be premium prices. And from the fair price or 50 DRT to the dealing range low, or that lowest price, all of this is going to be discount prices. Now, the market is going to move from premium to discount and discount to premium. Now, this again gives us more information. What has price previously done? We've seen price has spent time here inside of an extreme premium market. So from the 25 to the dealing range high, this is going to be our extreme premium. This is very, very high prices relative to this dealing range. Now, watch this. We have seen price run higher here into an extreme premium, but before that, it has raided a minor buy-side liquidity pool. This is minor buy-side because it's a liquidity that rests inside of the range. This is internal range liquidity. Not only has price raided and purged all that buy-side liquidity, it has balanced this inefficient area of price. We have, again, from this candle's low to this candle's high, this candle only offers sell-side delivery. This is inefficient price action. This is our daily fair value gap. Again, look at where the bodies have closed. They haven't even managed to get into that daily fair value gap. Again, a huge indication of weakness. Now, how do we interpret this information? Well, we know that in order for smart money or large banks and institutions to move money, they need liquidity. So if they are going short, they need to pair their short orders with retail buy-side liquidity. So essentially, they have to sell to somebody who's buying, and the buyers are going to be above all of this minor buy-side liquidity. Now, that buy-side liquidity is going to be in the form of buy stops above these relative equal highs. Again, the books teach us to place our stops above double tops, right? Also note here, between this candle's low and this candle's high, we have a smaller sell-side imbalance, buy-side inefficiency inside of that higher time frame weekly fair value gap. This is going to be influential going forward. So now that I have market structure, a higher time frame draw on liquidity down here with the equal lows, and I've assessed the price delivery continuum from the higher time frame down to a lower time frame, I can now get a little bit more granular here. So the first thing that I want to do is I want to look back 20 days from the current price, which is going to be on this candle here. Now, anything to the left of this candle for now I can ignore, because if I'm going down into more short-term trading, day trading, then I'm only going to be concerned about what's happened in the past 20 days. So I'm going to take this piece of price action and I'm going to zoom in here on this a little bit more. Now, what I want to do is I want to mark out the highest high and the lowest low in the last 20 days to see where my major buy side and my major sell side liquidity pools are. And we can see that above this high would be our major buy side liquidity, and below this swing low down here in the last 20 days, this is our lowest low. This is where major sell side liquidity is going to reside. Now, this forms a dealing range here. We can grade this entire range with our DRT levels. Notice where price action currently is. It's around this 50 DRT level, which is that fair price between the highest price and the lowest price. It's worth noting over here that this candle really closes through that 50 DRT level and that weekly fair value gap. This is a very strong signature in price that the market has turned around here. Now, one of the things that we can use for DRT levels is if we can see price has displaced from one DRT level straight through another DRT level and has left a gap we can class this gap as a breakaway gap, and we do not anticipate price to return back up into this gap. So again, this is giving us another clue that the market here is very heavy. Also, with this 50 DRT level being in very close proximity to the consequent encroachment of the weekly fair value gap, as you can see here in this black dotted line, this again is further clues that a setup may be forming here on the lower time frames. Furthermore, this leg here ran a previous high within the last 20 days, forming our dealing range high, and then price turned around and dropped right through the weekly fair value gap, the 50 DRT level, and that swing low that raided that 20-day high and all the highs to the left over here as well. It dropped below it with a close, making this a high probability break-in structure. Also note inside of the leg, that break structure, we have this fair value gap. Now, this fair value gap is a high probability fair value gap. It's inside of the daily fair value gap to the left, and the premium high of this fair value gap overlaps with the consequent encroachment of the weekly fair value gap, when we already have established that this fair value gap is likely to remain open here. So again, we have a higher time frame draw on liquidity with the weekly time frame with those equal lows below the market. But because we're going to be looking at more shorter term trading, we can still use the higher time frame as a draw, but we can use lower time frame targets. Now, within this dealing range, we want to look for the extreme low. So the extreme low is going to be where we have this major sell side liquidity pool at the dealing range low. Now, remember, the algorithm is going to reach for one of two things: liquidity and inefficiencies. When we have areas where they both overlap or are in close proximity to each other, that is a very, very strong draw on liquidity. And if we look below this major sell side low, we can see the remainder of this buy side imbalance, sell side inefficiency still open, right? So from this candle's low to this candle's high, the bottom half of it sits below that major sell side liquidity pool. So this is going to act like a magnet for price to draw down into. This is what we refer to as a draw on liquidity. Let's drop even further down into a 4-hour time frame now. Not only is it one thing to do a correct top-down analysis, we have to also find trading setups that's going to yield a good return. This is very crucial, right? So on these lower time frames, what I'm really doing is fleshing out a few things. I'm looking for potential targets, I'm looking for a potential entry, and I'm using the lower time frames to refine my stop loss. Now, here on the 4-hour, straight away I can see that we have a minor sell side liquidity pool where we have all of these equal bodies. This is going to be an initial consolidation on a lower time frame, so I know that the market is probably in some kind of market maker sell model. I will do a video on that at some point, so make sure you subscribe to this channel. Now, similarly to the daily time frame, below the sell side liquidity, I can see another buy side imbalance, sell side inefficiency below the market, again in close proximity. This is going to act again as another draw. So this would potentially be my first target area on a lower time frame. Now, what I also want to do is understand where the market isn't likely to go. And this is where I start stacking PD arrays. PD arrays are going to be the ladders that the algorithm uses to facilitate the movement from buy side to sell side or inefficiency to inefficiency. So let's see what's happened here. Again, we had these relative equal highs within the last 20 days. So there's going to be a big pool of buy side liquidity resting above those highs. Now inside of this leg here that raids that buy side, then turns around, closing below it, which constitutes our high probability break-in structure as we discussed on the daily time frame. Now inside of that swing, we see this down close candle that's nested in the upper half of the weekly fair value gap. This is our high probability breaker. We can draw that out in time and notice that the closing price of that breaker overlaps with the consequent encroachment of that weekly fair value gap. So we now have a couple of nested levels here, again supporting the idea that we may have a potential trade setup. It's also worth noting, inside of that daily fair value gap, this black dotted line is its midpoint or the consequent encroachment. And you can see how all of the bodies here are acting around that level, again failing to close above it, indicating a sign of weakness. Let's drop further into an hourly time frame. And here I'm going to delineate the opening price on Sunday and extend that out in time. If we are bearish and I anticipate lower prices for the week, and I anticipate that the weekly range is going to close lower, then I want to see price early on in the week run higher above the weekly opening price. This is because retail, who are excited at the beginning of the week, are going to chase price as it runs higher. Now, how high is it likely to go? Well, if I take the highest high and the lowest low between Sunday's opening candle and Monday 12 a.m.'s opening candle, which is going to be this high and this low, and project deviations higher, generally between 2.5 and 3 deviations is what I'm aiming for. And if it overlaps with a key level, like we have here, which is a consequent encroachment of that daily fair value gap, and it's a Monday, Tuesday, or Wednesday, I know that there's a high probability that the high of the week here is likely to form. Now, this high forms on a Tuesday. And notice that it sweeps the buy-side liquidity above these relative equal highs to the left, which also includes Monday's high. Then price stays inside of a consolidation, engineering sell-side liquidity below the consolidation's low. Now let's go further in time and see what transpires at Wednesday's opening price. So to do that, we'll drop down here onto a 5-minute time frame, and I'm going to get rid of this blue shaded area since that's the higher time frame daily fair value gap. Now we can still use that here, but that's for another lesson. The main thing here that I want to focus on is the opening price at midnight New York. If I am bearish, I want the market to move above the opening price before going lower, and we see that here. Now what I also want to do is I want to look left at the near-term dealing range, and in order to do that, I want to see where the highest high has been raided and where the lowest low has been raided prior to 12 a.m. and we can see that here. We had the high rated here, and we had the swing low rated down here, forming a new dealing range high and a dealing range low. So now the algorithm has a price range to work within. It has its highest price, its lowest price, and it has its mid price with the 75 and the 25 levels. If we are bearish, we want to sell at premium prices. So we want to see the market move above the 50 DRT level. Now, it just so happens that above the 50 DRT level, we have this 5-minute fair value gap from this candle's low to this candle's high. That sits within the range of this down close candle here, where we have a high, we have a low, we have a higher high. So this is our bearish breaker. And we also have a reclaimed fair value gap to the left, as well as these consecutive up close candles as an order block. So again, there's a few levels here that are nested and stacked together inside of a premium market relative to this dealing range. Not only that, we have a minor buy side liquidity pool above price after 12 a.m. where we have equal highs. So I was sat here in front of my charts just prior to London, and I put a stop order at the low of the 5-minute fair value gap, plus a few pips for spread. And I got in here on this wick. My stop would go above the dealing range high. Now, this is textbook DRT model, which I've taught here for free on this YouTube channel. Now, watch what happens. Price runs higher one more time, and then drops lower, leaving this buy side imbalance. When price closes back through it, this becomes an inversion fair value gap. Also note that this candle closes back below the opening price. Again, this is a significant algorithmic signature. Note what's left. We have this minor sell sued, apparently. We have this minor sell side equal lows, and we see price retrace back higher into the consequent encroachment of this 5-minute inversion fair value gap. So I got in right at that level, again with my stop above the dealing range high. This was my second entry. And then price drops lower, raiding that minor sell sued liquidity pool. Now, if we zoom back out to the hourly time frame, we have that daily opening price over here on Wednesday. We have our first profit target down here, which was Monday's low. And this was the near-term intra-week low. Now, resting below that was that 4-hour fair value gap. So this is going to be a very strong draw on liquidity. And we see price absolutely tank straight through that 4-hour fair value gap. Now, it did this so quickly that by the time I look back at my charts, I had already had profit taken. So I moved my stop to break even and let the trade run because I anticipated that daily sell side liquidity pool. Remember that major buy side liquidity that we had on that daily dealing range. So I knew price was going to go lower still. So if we zoom out here, you can see how we ended up dropping for that daily low, which rested above the remainder of that daily fair value gap that we spoke about earlier. Now, I managed to get a screenshot of the trade just before we actually went a little bit lower into that daily low. Around 133.30 is where I got out. I had my stop here rolled to break even. Now, this yielded 175 pips with a risk to reward ratio of 34. Now, let me just be honest here for a second. This isn't a typical trade, right? I can find very, very high yielding risk to rewards trades based on this systematic approach to top-down analysis and the fact that I've been trading ICT concepts and algorithmic price delivery for the last 8 years. So there's been a graduation in my development as a trader over the years. Now, I'm also not here to flex. This is why I hide my lot sizes and I don't flex my wealth or my lifestyle. But what I want to make you aware of is that the knowledge is transferable. And if you really do study this, these are the type of trades that you can do yourself. But I also want to be realistic with your expectations that don't expect this to happen overnight. I've been trading for almost 10 years now, and it's taken me a very, very, very long time to be able to interpret and read the market the way I'm able to read it. So if you can appreciate that, then drop a comment below, like, subscribe so that I can continue making videos with as much value as I possibly can without the ICT rants and stuff, right? Now, there was a third entry that I could have got into, but unfortunately I didn't get into this entry, but it was a really nice clean setup again. After reacting here from that 4-hour fair value gap, we retraced higher into that 50 DRT level from the higher time frame, which I've got here in this red dotted line, and that overlapped with this inversion, buy side imbalance, sell side inefficiency. And you can see how we nail that area here and the body's failing to close above it, and then we displace lower again back into the order block, nested with that initial intra-week low, and then you see price roll over, and again the reaction lower there. When I opened up my phone to check my chart, I was actually surprised with how far price had already traveled. So I managed to get a screenshot around here, and then I got out right at that low there. And this is what it looks like here on the daily time frame. So that was that sell side liquidity below the dealing range low, and the remainder of that buy side imbalance. Now, of course, we had the equal lows below here, which was the ultimate target. And you can see how price ended up really digging into those lows, completing the objective that we initially outlined. Now, I outlined all of this in my mentorship group when we were up here, and a lot of my students managed to capitalize and did really well in this decline lower. And on that point, I've had a ton of emails asking me about mentorship. Enrollment is back open again for a short time. I'm really restricting numbers just so I can keep the quality of the teaching as high as possible. If you are serious about taking this to the next level and you want to learn from somebody who really, really understands this stuff, then click the link below and fill out the application. Spots are limited, so I'm only reserving this for traders who really want to up their game. If you're not quite ready for mentorship yet, or you don't have the investment for that, then that's absolutely fine. Click the link below and get started with the ICT Bible, and I'm also got a free training webinar that can get you started as well. So I hope you have found this one insightful. Again, please like, subscribe, comment below on what else you want me to do teachings on. And as long as you're getting value here and this is helping you, then I'll continue to keep making these videos. So again, thank you for watching, and I'll see you in the next one.